Today's topic for revision is goodwill, treatment of goodwill, the different methods of valuation of goodwill. We are just going to see the practical side of the different methods of valuation of goodwill and the steps that we have to use in valuation of goodwill using those different methods. Basically, for you in the syllabus, you have 4 methods. One is the average profit method, super profit method, and the third is capitalization method, in which we have capitalization of the average profit method and capitalization of super profit method. Now, within the average profit method, we have 2 methods, simple average method and weighted average method. Now, in valuation of goodwill, when you're using a simple average profit method, here we are just going to use a simple formula of goodwill is equal to average profit into number of years purchase. So what is average profit? We just take the total of the profits of those different years and divide it by the number of years to get the average. Like we find the average of 4 numbers by totaling up the 4 numbers and dividing it by 4. Same way we find the average profit. And then we multiply it by the number of years purchase. Now what is number of years purchase? It is nothing but the number of years for which you expect that you'll be able to earn the same amount of profit because of the efforts that you've put in the past. So that is the number of years purchase, which is usually will be given to you the question. There's nothing to calculate. It's just a concept that you need to know. So you'll have to multiply it, and the amount that you get is the value of goodwill as per simple average profit method. Like for example here, 3 years profit was, so 4 years profit was given here. Then what would be the value of goodwill if 3 years is the number of years purchase is 3 years? Simple. Add these 4 years profit divided by 4. You get the average profit, which is 30,000 in this case. Multiplied by the number of years purchase, which is 3. You get the value of goodwill. As simple as that. That is simple average profit method. Weighted average profit method, the difference is instead of taking the average profit, you're going to take weighted average profit. Now, what is weighted average profit? Simple. Weighted average profit means we assign weights to the profits. Why are we assigning weights? We are assuming that the most recent year, past year, in the past there are 5 years. The most recent year would be the 5th year. Like this might be 22, 21, 20, 19, 18. So most recent year, whatever is the profit, that is more likely to be earned in the future. The 6th and 7th year, you're going to expect it is going to be on this line. Therefore, we will assign the highest weight. So what we do is we start assigning weight as number 1, 2, 3 starting from the earliest year. So earliest year, whatever you have would have 1. Then go on writing 1, 2, 3, 4, 5 on the basis of number of years as weights. Then find the total of the weights. And weighted profits is nothing but profits into the weights. That will be weighted profit. Then, like that you find for each year, total it up, and this is the weighted profit. But we need weighted average profit. How do we find that? We take the weighted profits divided by 15. So that would give you the weighted average profit. Then multiplied by the number of years purchase they have given the question. That would give you the goodwill under weighted average profit method. Is that clear to everybody?
Yes, ma'am. Yes, ma'am.
Okay. This method is very simple. Now, next is a super profit method. Note down these steps for all this. If you follow the steps systematically, you'll be able to solve it. Very easy. Now, simple profit method. Now, what we're saying is when a firm is able to earn a level of profit which is higher than what other firms are able to earn the same amount of profit at the normal rate of return, then we say that there is super profit. And that super profit is going to be used and multiplied with the number of years purchased to ascertain goodwill. So what is the step? First thing we'll take is the capital employed or average capital employed. If they give you the capital at the beginning and end, you can find the average, add them up together and divide by 2. Or If only one particular detail is available, you calculate the capital employed using the formula for capital employed, and that would be the basis for capital employed. Second, we would find out the average adjusted profit earned. So they would be giving you the profits of certain number of years, 3 years or 5 years or 4 years. And there might be adjustments, like there might be overvaluation of stock, undervaluation of stock, or some other adjustments in the question. That on that basis, you will have to add or subtract the amount, adjust the profit, and then you find the average of it. So you have the profit, you adjust it, add or subtract, and then find the average of it. And you arrive at the second step. Then this is the average adjusted profit. This is the actuals. But next step you compute the normal profit. Means normally if any firm is using this much of capital, then at the normal rate of return which is expected from a business, how much would be the profit? That is normal profit. Suppose 10 lakh is being used in our business and we are earning a profit of say 1,20,000. If they say the normal rate of return is 10%, it means that any other firm also in the same line of business, if they're using 10 lakhs, then at the rate of 10%, they should be able to earn 1 lakh at least. How? 10% of 10 lakh, 1 lakh. That is a normal profit any business. Means if I do the business in that particular line of business with 10 lakh invested, I should get at least 1 lakh. But if your business is earning 1,20,000, means you are doing much better than others. That shows your efficiency, capability. So that extra amount, that is super profit. So your average profit is 1,20,000, whereas normal profit is 1 lakh. So you're having a super profit of 20,000. That super profit into number of years purchased as given the question would give you the amount of goodwill. Is this method clear? Girls, clear?
Yes, ma'am.
Then we have the capitalization of average profit method. We are going to do questions on these methods. First, understand this concept, note down these steps in your notebook, and then when we apply it, you will be able to corroborate it. Capitalization of average profit method. Now here, basically, we are computing the average normal profit which is earned. Then the next step, we are going to find out the capitalized value of the firm. Means to earn that much of profit, how much should have been the capital used? How do you calculate that? We take the average profit divided by the normal rate of return into 100. So at that normal rate of return, if this profit is being earned, then we come to know how much capital should have been employed. But the next step, we are going to find out the value of net asset. Means this is the actual net asset, the capital which has been employed in the business to earn this profit. That is, you take all the assets, but remember, you're going to exclude some like the goodwill, fictitious asset, non-trade investment, and then subtract the outside liabilities, you get the net asset or the capital employed. So this is your actual capital employed. Now we are going to compare the actual capital employed and the capitalized value of the firm. If you are using lesser than what is being at the normal rate of return, what is required to earn that profit, then it means you are efficient and there is goodwill. So that is why goodwill is capitalized value of the firm minus the net asset or the capital actually employed in the business. Is this clear? Girls, clear?
Clear, ma'am.
Last method is capitalization super profit method. So here there are 5 steps. First, you calculate the capital employed or the net asset, which you have seen how to calculate. You take all the assets but exclude certain assets like the fictitious asset, the non-trade investment, and then you subtract the outside liability from that. Then you get the capital employed and net asset. Then you calculate the normal profit on this capital employed. How? With this capital employed at the normal rate of return, that is capital employed into normal rate of return by 100, you'll get the normal profit. Then you calculate the average profit of the past years, whatever is given the question. Compare these two. If you're earning more, that is if the average profit is more than the normal profit, it results in super profit. Then goodwill is super profit divided by normal rate of return into 100. The super profit by normal rate of return into 100. So that is the amount of goodwill. So this is how we are capitalizing the super profit. So till here it is the same. You will be calculating the super profit as per super profit method. Goodwill valuation only, this formula you need to remember. Clear?
Yes, ma'am.
Good. Now let's do some questions. Different variety of questions we will do. Okay. So this is the question. Everybody got this question? Take a screenshot of this question. Look at this. Now we are not going to just apply this step and do it. We are doing a little different type of question, like where in this case you have not calculated goodwill but capital employed. So how will you do that? They've given you average profit of a firm during the last few years is 80,000. So average profit directly given, nothing to calculate. The normal rate of return in the similar business is 10%. If the goodwill of the firm is 1 lakh, so goodwill is available, at 4 years purchase of super profit, then you're supposed to calculate the capital employed by the firm. Can you do this? Taken a screenshot?
Yeah, ma'am.
Now, with that question, what was the detail given? We'll write it down here. Average profit was directly calculated and given to us as 80,000. Normal rate of return was given to be 10% in similar business, and they said the goodwill of the firm was rupees 1 lakh and goodwill was calculated as 4 years purchase of super profit. What they want us to calculate? They want capital employed. So now let's do the calculation here. You have to apply the concept that you learned. So here we'll start with this particular thing. Because we have the goodwill, we know 4 years purchase we'll be able to get super profit. So we'll start with that. Goodwill is equal to super profits into 4. Goodwill is 1 lakh. We're replacing it with numericals. Super profits unknown into 4. So super profit is, we bring this down, 1 lakh by 4 would be rupees 25,000. So we got the super profit. Now, next we have the average profit. We found out the super profit. Using that, we can find out the normal profit. Do you remember the formula for super profit? Super profit is equal to average profit minus normal profit. The super profit will replace 25,000. Average profit 18,000 minus normal profit. So we will take the normal profit to other side, becomes positive. We bring 25,000 this side, it becomes minus. So normal profit would be 80,000 minus 25,000. That would be 55,000. So we got the normal profit as well. Now once having reached there, next we have this normal rate of return which we have to use. How do we calculate normal profit? What was the formula for normal profit? Remember, normal profit is equal to capital employed into normal rate of return by 100. Now we have this amount 55,000. Capital employed, that is what is to be determined. We have the normal rate of return given as 10%. So take it to the other side. Capital employed would be how much? 55,000 into 100 divided by 10. Rupees 5,50,000. Everybody clear? Done, girls? Is it clear? Any doubts?
Done.
Okay. Now we'll go to the next question then. Others done?
No, ma'am, just a minute.
Okay, sure. Let me know what's done.
Done.
We'll go to the next question. This is the next question. Take a screenshot of this. A firm earned average profit of 3 lakh during the last few years. So average profit 3 lakh. The normal rate of return of the industry is 15%. So normally any business investing certain amount of capital will get 15% return on it. The assets of the business were 17 lakh and its liabilities were 2 lakh. So net asset would be 17 lakh minus 2 lakh, 15 lakh. That is capital employed and net asset. Calculate the goodwill of the firm by capitalization of average profits. So this method we are going to do. Screenshot taken.
Yes.
Okay. So let's do this question then. Come on. We'll write down the details. They have given the average profits of last few years is rupees 3 lakhs. Then they've given the normal rate of return is 15%. The assets of the business was 17 lakhs and the liabilities was rupees 2 lakhs. So they want us to calculate goodwill by capitalization of average profits. So first thing, step 1, we have the average profits, which we already have rupees 3 lakh, nothing to calculate. Then second, we will capitalize the average profit. We'll find the capitalized value of the firm, which is average profit by normal rate of return into 100. So that would be how much? 3 lakhs divided by 15 into 100. 15 ones are 2s are followed by 20,000 into 10, 100, that would be 20 lakhs. Next step, what are we supposed to do? Find out the net assets or capital employed in the business, which is here total assets minus liability. Details of any non-trade investment or fictitious is not given. So we assume there's nothing of that sort. We just find the difference between the two. So 17 lakh minus 2 lakh. So 15 lakhs. Now we have to find out the capitalized value, goodwill as a capitalization of average profit. Now what are we supposed to do? Goodwill as per this method is capitalized value of the firm minus net assets, which is capitalized value was 20 lakhs. Net asset is 15 lakhs. So rupees 5 lakhs is the goodwill. Got it? Any doubts?
No.
Finish it up and say done. Meantime, I'll send you the next question. Done?
Done.
Yes.
Done. Done, ma'am.
Now we'll go to the next question. Now here, take a screenshot of this question. The firm of P, Q and R earned 4 lakh average profits during the last 3 years. So average profit given 4 lakh. The capital employed in the business was 6 lakh. Capital employed 6 lakh. Normal rate of return of the industry is 8%. Calculate the goodwill of the firm by capitalizing the super profit. So we are doing now question on capitalization of super profit method. We have done capitalization of average profit method. We have done the super profit method. Now we are doing a question on capitalization of super profit method. So let's start. Write down the details first here. So they said the average profits was rupees 4 lakh. Then they said capital employed in the business was rupees 6 lakhs. And the normal rate of return was 8%. They want us to find out the goodwill by capitalizing super profit. So now, first thing we needed, the first step was average profit. That is already given to us. Rupees 4 lakh. Then they have also given us the capital employed. No need to calculate, simple. Rupees 6 lakh. Now we have to calculate, this is capital super profit. So we have to find out super profit. To find out super profit, we need to know the average profit and normal profit. Average profit available, normal profit we have to calculate. So next step we will calculate normal profit. What is the formula for normal profit? We will take the capital employed and the normal rate of return. So capital employed into what? Normal rate of return divided by 100. So 6 lakh into 8 by 100. 48,000 is the normal profit. Now, this 4 lakhs. So what is the super profit? Super profit formula is average profit minus normal profit. So average profit 4 lakhs. Normal profit is 48,000. So what is a super profit? 3,52,000. So far clear?
Yes.
Next, we have to find out goodwill, and this is by capitalizing super profit. So the formula is super profit by normal rate of return into 100. Super profit we just got 3,52,000. Normal rate of return was 8% divided by 8 into 100. So it would come to 4s are 32, 4s are 32, 0. So it is going to be 44 lakhs is the amount of goodwill. So this is how we ascertain goodwill using capitalization of super profit method. Any doubts? So everything clear to everybody? Yes or no?
Clear.
Once you're all done, let me know. I will just do 3 or 4 Simple bonus questions I'll give you, theory part of this goodwill. And then we'll stop here for today. Done, everybody?
Done, ma'am.
Others done?
Yes, ma'am.
Now, for the theory part, some bonus questions for you before we end the session. First one. Goodwill is an dash asset. Who can tell me?
Fixed intangible asset.
Very good. It's when there's an, you remember, it's an intangible starting with a verbal. Intangible asset. Excellent. Next. Intangible asset. Okay. That is, in this case, we're talking about goodwill. Has been defined in which accounting standard? Do you remember the accounting standard number?
AS 26.
Excellent. Very good. Next. There are two types of goodwill. So in that, goodwill which is not purchased but which is earned by the efforts of the management is called as what? One is purchased goodwill. The other one is
Self-generated.
very good. Self-generated goodwill. This goodwill is never recorded in the books. It is a purchased goodwill which is recorded in the books. Then, what is the formula for super profit?
Average profit minus normal profit.
Very good. And one more before we stop. That would be, tell me the formula for goodwill under capitalization of super profit method. We just did that. So how do you calculate goodwill when it is by capitalization of super profit method? Just
Super profit minus normal rate of return into 100.
divided by normal rate of return into 100. Very good. That's it. So like these, you can get some 1 mark question somewhere. Some calculations might be required. They might give you these details or they might ask you for an amount. They might give you the details and ask you to calculate goodwill. That also can come for 1 mark. So I hope it was a useful session.